If you get back over 25 again, put your helmet on. So if you look at a price chart, the last two highs, I think it was July and August, were just above 25. So getting back there again, somebody's going to say, well, let's sell it again. Better not. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year. Back in 2010 or so to 2011, silver went from like $20 to 50. Did most of its move in about 3/4 of a year. Same was true in 1979. Silver exploded and got up to 50. It did most of it in 3/4 of a year in 79. We're getting late in this bull trend too, so it wouldn't shock me that either 2024 or 2025 is that year where you get verticality.
With his extensive experience in commodities investing and expertise in momentum structural analysis, MichaelOliver asserts that silver has successfully overcome critical technical obstacles. He makes a compelling case for silver to outperform gold in the coming years. Silver exhibited a back-and-forth movement during Wednesday's trading session, hovering just above $24. According to the silver price forecast, there is a potential for the price to surpass $32 by the end of 2024. Oliver delves into the silver-to-gold ratio, highlighting historical fluctuations and underscoring the potential for silver to outperform if it reverts to historical percentage levels relative to gold. Once the gold-silver ratio falls below 80 and silver gains momentum, silver has considerable potential to swiftly surpass critical technical and psychological thresholds at $25, $27, $30, and beyond. Surpassing $25, silver is expected to initiate an upside momentum, and breaching the $30 mark will likely intensify gains, marking a transition into a full-fledged bull market for silver. Oliver thinks silver has successfully navigated several technical challenges and is positioned for another substantial upward movement. The price of silver experienced a 2% increase, reaching $24.82 per ounce, marking the highest level since September 1st. It peaked at $24.26 during the session, following a 1.9% gain on the previous Friday, marking the second consecutive profitable session, propelled in part by weak U.S. economic data. Last week, silver witnessed a 2.5% rally, marking its second consecutive weekly gain. This surge was attributed to a decline in the U.S. dollar and Treasury yields and an uptick in demand in China. Before diving into MichaelOliver's insightful interview, subscribe to our channel and give this video a big thumbs up.
It's been a horrible 3 years of plateauing by silver. While gold went sideways with repeated highs over 2000, silver went into a gradual declining trend channel, which we've actually sort of emerged out above if you look at just price even. Where you make a high at 30, you make a high at 28, you make a high at 26, make a high at, et cetera. So it's been gradually decaying with some nice spike lows down there. Like we were $17 last year, now silver's 23, 24 zone. Well, percent-wise, that's a bigger move up off the low than gold is off of its October low last year. But still, people have been bemoaning it. We think silver's broken through every technical hurdle we need to see to indicate it's restarting itself. Another major up leg. The last signal we're going to offer, and we get very specific with our subscribers, but basically it's if you get back over 25 again, put your helmet on. Now, if you look at a price chart, the last two highs, I think it was July and August, were just above 25. So getting back there again, somebody's going to say, well, let's sell it again. Better not. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year. And a major point we're making too. The prior bull trends in gold lasted about 9-10 years or so. Early 70s, it was in the $30 zone, went to $8.50, okay, by 1980, okay. 2000, year 2000 was trading around $2.50. By 2011, it was $19.20, okay. But a decade or so. Most of the percentage of the price gain of those bull markets came in the final year of the bull trend, meaning the 8th or 9th year or 10th year. We're now 8 years old, bottomed in late 2015 at 1,050. We've doubled since then in gold, okay? So it hasn't had the ratio move of those moves, which were eightfolds. We've only doubled. And yet we've got these macro fundamentals that could drive it a lot higher. But you've got to be careful because late in the trend, after laborious bull trend, that's when you get this engagement that is so dynamic that it takes your breath away. Like, for instance, I think it was back in 2010 or so to 2011, silver went from like $20 to 50. Did most of its move in about 3/4 of a year. Same was true in 1979. Silver exploded and got up to 50, or it did most of it in 3/4 of a year in 79. We're getting late in this bull trend too, so it wouldn't shock me that either 2024 or 2025 is that year where you get verticality, especially given the fundamental and technical dynamics in these other asset categories that will drive the Fed to liquidity issues again, which will fuel the gold move. And silver. Ratio basis. Silver to gold, if you look back historically over the last 50 years, you'll see it's gone up to 6.5% of the price of gold. It's been multiple times well over 3% of the price of gold. So it's not like it's rare for it to be there. Right now, it's above 1% of the price of gold, like 1.3. If gold were to match the ratio moves that it had in 1970 and 1980, or 2000 to 2011, it would go to $8,000 and merely match the ratio. If silver were even 2% of the price of gold, or 3% of the price of gold, and gold was at 8,000, you do the math. It's off the page, hundreds of dollars. We don't think it's a ridiculous assertion, and I think that a lot of that is going to occur late in this bull cycle, which began again from the 2015 lows. So I think silver is going to be an outperformer.
Oliver expresses confidence that the upward trajectory of gold won't be halted at $2,000 this time, indicating a sustained bullish outlook. As of just before midday on Wednesday, gold prices are elevated. Based on February COMEX futures, the yellow metal is currently undergoing some consolidation on the charts following a spike on Monday that saw prices reach a record high of $2,152.30. Notably, Oliver emphasizes that gold has consistently factored in the expectation that central banks will resort to familiar strategies such as printing money and cutting rates in the event of a paper asset bubble burst. Analysts anticipate that gold prices are set to achieve new highs in the upcoming year, with the potential to remain above the $2,000 level. This projection is attributed to geopolitical uncertainty, the likelihood of a weaker U.S. dollar, and the possibility of interest rate cuts. Let's get back to the interview.
The trend direction of T-bonds, and we're talking price now, so if price goes down, yield goes up. Okay, remember that. T-bonds we got bearish in 2020, late 2020, well before we got bearish on the stock market in early 2022. But bonds started a major bear market then, the yields rising. Okay. They made a low last October, a year ago, at a level that we predicted would be a bounce point, but only a bounce point. And sure enough, they had a nice bounce. They ran up nicely and they stabilized. Well, you'll notice last October, stock market also made a low, and so did gold. Gold was in the low 1600s. It was a bear trap low, we defined it as. Meaning, if you sold that downside breakage, you're caught in a bear trap. Okay, and sure enough, it exploded back to 2000 again. But during that same time, T-bonds rallied from the October low. S&P rallied. And T-bonds then leveled off and basically peaked around March or April of this year. It started to roll over again. What did gold do? Same thing. In other words, T-bonds were technically in linkage with gold, which was very interesting because it doesn't always happen, but sometimes it does. And we defined that months ago, that watch the T-bonds and gold because they seem to have their legs strapped together, almost week by week. And we made a difference, though, because we saw gold pulling back and it dropped into the 1800s, this October. Whereas T-bonds crashed. They didn't just go down. They took out last October's low, which would be like gold being below 1600 if it had matched it. And, well below there. And they did it in crash mode. There was the T-bond chart. If you looked at it, it looked like some collapsing commodity market. Didn't look like what the U.S. government debt market should be looking like. I know it had to vastly upset Yellen and the central bank and the Feds, because that's the asset they can't have crash. They don't care about NVIDIA or something like that. If that happens to go down, they couldn't care less. But their T-bond market, that's life or death for them. And so we argued that expect a V-bottom in the T-bond market. And in fact, we've gotten one over the last month. Lagged to gold. Gold turned up about a month before T-bonds did, but then T-bonds got back in sync with gold and had a sharp rally. Now, gold was back to its all-time highs, but T-bonds were having what we call a V-bottom. And I think in part that was due to overnight buying by the Treasury and the Fed, in the dark type buying. And there's also some very large asset managers out there who realized that while bonds were a horrible place to be last year, they were even worse than the stock market. So the 60-40 portfolio was lethal. That the bonds were oversold now and likely to be worth buying. And I think they plowed into the bond market. That's why you're getting this V bottom. But I suspect what it means is, and I think the broad market interprets it partly as one of the factors, the Fed can't raise rates anymore. No matter what they want to say, they cannot do it. They cannot destroy their bond market. At all costs, they have to print, whatever it takes to support that market. So I think the stock market right now is pricing that in. I think gold has all along priced that in, meaning it's always known that when the paper asset bubble breaks, stock market, the central bank will have to revert back to that which they do best, which is monetize debt, print money, cut rates at some point. That's why it keeps coming back to its highs. Find me a commodity, or find me any asset almost on the planet that has kept coming back to its highs. Gold is the one, okay? It has a reason for that. And we don't think it's going to stop at 2,000 this time, by the way.
In European trade on Monday, silver prices surged over 2%, marking the third consecutive session of gains and reaching a 3-month high, approaching the significant threshold of $25. This week's recent decline in U.S. Treasury yields has supported bullish sentiment in both the gold and silver markets. Traders and investors are eagerly anticipating key U.S. economic data points that are imminent. As of the latest update, February gold has risen by $10.80 to $2,047.00, while March silver has experienced a modest decrease of $0.116, currently standing at $24.43. What factors will play a crucial role in determining the future trajectory of precious metal prices, particularly silver, in the coming weeks? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.